Hi friends, today we are going to review the latest June CPI report out of the US. This set of inflation report, it was absolutely crucial because the Fed had spent so long trying to keep inflation down and they're waiting for the right timing for the rate cuts, and they want to get more confidence that inflation is moving towards 2%. So this set of report not only has a huge implication on the Fed's next move, but also the broader financial markets, including the stock market. So we'll cover all of these aspects today and dive into the actual numbers. Before we get onto the numbers, I just want to elaborate slightly on what CPI stands for and how it's different to the PCE. So the CPI is the Consumer Price Index, and not many people may be aware of this, but it actually only covers the urban area inflation. And huge components of that would be rent and shelter. In comparison, the PCE, which is actually what the Fed supposedly use for its inflation target, covers all of the urban and suburban areas. What that means is that CPI and PCE are often out of sync because they have different component weightings, and CPI has been quite above PCE recently. Okay, now let's take a look at the numbers. Before the actual data release, the consensus was that the CPI would rise by 0.1% month on month, which translates to 3.1% year on year. So this would be the consensus pulled across the leading economists from different investment banks and asset management houses and research houses. The actual data came in with a big downside surprise because for the first time since 2020, we actually got a negative month-on-month figure for the headline CPI. So the headline CPI came in negative 0.1% month-on-month, which translated to 3.0% year-on-year. So that was well below the expectation as well as the previous month CPI. And now even looking at the core CPI figure, which is what the Fed cares most about, and the core CPI excludes food and energy because these are volatile components which can swing about month to month. Core CPI actually came in 0.1% month on month, again below the forecast of 0.2%. And just to show you how big this report was, if you look at the Consumer Price Index for the past 5 years, you will see that the last time the headline CPI touched the negative territory was actually during COVID, and indeed there was a recession around then. So what's really driving this surprise downturn? If this continues, we're not really talking about cooling inflation anymore. We're actually going to talk about deflation. The key driver for this negative headline result was actually energy. If you look at this chart here, energy as a basket went down by 2%, which is very big. And nearly all of the components went down except for the utility gas services. And you can see that gasoline, motor fuel, and energy commodities actually went down by almost 4%. And this was somewhat surprising because in June, actually crude oil prices went up quite significantly in the month. And just to show you this chart here, the WTI crude, which is the crude oil produced in North America, the price per barrel went up from $72 to $84 between beginning of June and beginning of July. So that was quite a big jump. And now we're looking at the CPI components across board on a year-on-year basis. We can see that the motor vehicle insurance and shelter are still pretty high here, but the used car tracks and airline fares have gone down quite a bit from last year. So where does this leave us? I think at the beginning of the year, in Q1, the Fed was very worried that inflation was getting resurgent, and we had 3 hot readings across Q1 that pushed the Fed to say, hang on a second, let's keep the rate cuts on hold for now. Let's get more readings, get more confident about inflation heading towards 2%. But actually, if you look at where we are now, inflation has definitely begun to move down again. It did get a bit sticky in the past 12 months, especially the headline CPI. And the services component, less rent, actually went up quite significantly starting from September. But now maybe the tide is really turning. You can see that services-less rent just began moving down as well. And the headline and core CPI measures are now also heading down after a hot and sticky Q1. In fact, if you look at the 3-month annualized basis, all of them are dropping like a stone. So what this means is that if you extrapolate the data of the past 3 months for the full year, we're actually seeing rapid deceleration in the inflation measures across the headline core as well as the services-less shelter. This to me suggests that maybe the Fed is being a bit prudent right now by not signaling a rate cut soon. Of course, the Fed is divided between two camps. One camp thinks we should cut rate just once this year, and the other camp thinks we should cut rate twice this year. But actually, there's a case for 3 times, given where this report is at. Now, I will dive into that a little bit more in just a second. So now let's further zoom into the different components of CPI and how they've influenced the headline figures that we saw just now. So here are the breakdown of the CPI components into slightly more granular levels. One thing that really stands out is that food and energy really don't account for that much in terms of the overall CPI. The bulk of the CPI is actually made up by the core components that's without the food and energy. And importantly, 80% of the overall CPI is actually made up by rent, the owner's equivalent rent of residence, as well as motor vehicle insurance. And I will just slightly elaborate on what that means. So half of the CPI comes from the owner's equivalent rent of residences. So now this is actually an imaginary number that house owners supposedly should pay, but they never actually do in real life to account for inflation. This is slightly funny because house owners actually never have to fork this out each month compared with either actual rent or the car insurance I mentioned earlier. But it contributes towards 50% of the headline CPI figures. And since the beginning of this year, the house owners are supposedly paying higher amount of equivalent rent than the actual renters. Putting aside this absurdity, both the rent and the owner's equivalent rent have been going down quite consistently in the past 24 months, which is great. So the Fed believes that rent is really linked to housing. It's a yield on the house prices. And that's really affected by mortgage rates. And high mortgage rates means fewer people can afford housing. Therefore, it should drive house prices down. It should also drive rent down. And this is fairly a mechanical playbook that the Fed had deployed in the past. High interest rates should affect a lower reading in these inflation measures for rent. However, it's taken much, much longer than what the Fed had been expecting. Even Powell admitted this in last week's speech. But in any case, the rent and the imaginary rent that the house owners are paying are coming down and it's trending down this way. So I don't think the Fed should be overly concerned about this area. And the third key component that drives a lot of the CPI is the motor vehicle insurance. As you can see from this chart, car insurance prices have gone up steeply from January 2023, peaking right around March and April. And I think a lot of you probably would have felt this when you renewed your car insurance this year. And there are a few reasons have driven the surge in car insurance premiums. Firstly, there have been more cars on the road since COVID. More people have purchased new cars and second-hand vehicles during COVID, more cars on the road. So there's been a lag between the car prices and the car insurance premiums as new cars get on the road. Secondly, there has been a surge in the cost of parts due to the bottlenecks in the supply chain because of the Ukraine-Russian war, as well as the transportation effects during and after COVID. And there has also been a surge in the labor costs in fixing the cars, which have impacted the insurance prices. And finally, more cars on the road and maybe more new drivers have actually driven up the number of car accidents as well. So in fact, bad driving drives inflation. Who would have known? So back to this chart now. Car insurance premium seems to have peaked around April and is now steadily coming down. And to be honest, I'm not entirely convinced that interest rates would actually move this component that much. Now, where does this leave us for the future trajectory? So the Cleveland Fed actually has an inflation model called Inflation Now, and it continuously updates the inflation expectation for the current month every single day. If we look at the latest prediction for July, which is the month we're in now, because of the downside surprise in the June CPI report, the Cleveland Fed has actually revised down the expectation for July as well. The PCE at 2.47%, as well as the core PCE at the same rate, are actually below what the Fed had projected in its FOMC in June. The inflation outlook is actually rapidly changing to the downside. So how did the market react after the report? So here is the SOFR 3-month yield curve on the day, on Thursday. SOFR is the secured overnight financing rate, and it is a broad measure of the cost of borrowing cash overnight collateralized by Treasury securities. Before SOFR, traders used to use Euro-dollar futures, which were based on the 3-month LIBOR, but of course, because of the LIBOR scandal and the fact that it was such a subjective measure, now the financial markets have moved on to SOFR to hedge future interest rates. So the SOFR 3-month futures essentially bull steepened. What that means is that the majority of the swings on the day came in the 2025 and 2026 tenor, so just 1 and 2 years out. And in those regions, yields dropped by 12 to 16 basis points. Further out the curve, actually things haven't moved as much, maybe just 6 to 7 basis points 3 to 5 years out. And now moving on to the market prediction for the Fed's next move. So prior to the report, I think the market was pricing in just under 2 rate cuts for the year, starting from September and the second one being in December. The traders use Fed Fund futures to hedge the interest rate moves between the FOMC meetings, and is a collective insight on where the market expects rate cuts or rate hikes in the hiking cycle to be in the next 24 months. So now, after the report, the market is actually pricing in 2.5 rate cuts for 2024. Why is it 2.5? Basically, the September and December rate cuts are a done deal at this point. The question is whether the Fed would also cut in November, and the market essentially thinks there's a 50% chance of a November cut as well. The two scenarios would be either September versus December, or September, November, December rate cuts. And on Thursday, the stock market also reacted quite violently to this report. And the interesting thing is that the mega cap indices like S&P 500 and NASDAQ actually fell. And the growth stocks, the smaller cap, likely very unprofitable for now, but growing really fast, those stocks rose significantly on Thursday after the report. And if you just look at this chart, using the ETFs, SPY went down by 0.86%. The QQQ, which is the NASDAQ ETF, declined by over 2%, while the RWM, which is the Russell 2000 growth stock, smaller cap names, rose by 3.6%. And it was a first time in a long time, and it's a very rare occasion that RWM outperformed the QQQ by more than 5% in one day. So why did this happen? Well, the mega caps have mostly driven the stock market surge this year, including the Magnificent Seven, especially Nvidia. And I think basically the market has taken the chance on Thursday of a benign CPI report to rotate out of those mega cap names into the smaller names that haven't performed as well so far this year. And the theory is that the smaller growth names, which are highly unprofitable at the beginning of their growth trajectory, are highly sensitive to interest rate changes because most of the valuation are derived from the future free cash flows from 5 to 10 years out. and especially the terminal value of those free cash flows. So a lower discount rate, i.e. a lower interest rate, would actually discount the future cash flows back into a higher present value, which makes the companies worth more. Now, if you ask me if a 10 to 15 basis point change in the yield curve should actually imply a much higher valuation for the growth stocks, I don't think so. I think the narrative is running in front of where the math is. But I think people are getting very optimistic that the rate cutting cycle is starting soon, and it's time for the smaller names to start performing, especially with easing financial conditions where these smaller names can get more investments from the excess liquidity in the market, and they get a bit more room to breathe and grow as opposed to in a higher interest rate environment. But I think it's way too early to bet on the narrative. The Fed hasn't said anything since the report. The report is very fresh. Of course, they must be pleased to see such a benign set of CPI report, if not worried about the potential recessionary concerns given the latest non-farm payrolls report. But in my opinion, it might be just slightly too early to bet the farm on those smaller names outperforming yet. Very often, the market doesn't bottom until the Fed is near the end of its cutting cycle, and the markets tend to react violently to the downside when the yield curve uninverts, which means the Fed has started cutting rates and the future expectation of interest rates is higher than the short-term interest rates. And the final point I want to make is that I actually think the Fed should cut rates in the upcoming July meeting, right? And by then the Fed would have the PCE report as well. But I think it's really important for the Fed to get ahead of the narrative and expectation curve and manage the rate cuts first. We can even do just one and done for 2024 and stay data dependent after the first cut. And I think the markets are very well drilled by now by the data dependency approach of the central banks. I don't think that if the Fed cuts early and then see what happens next will be such a disaster in terms of communication or expectation for the markets. And actually, I think cutting one early and see how the data evolves is better than waiting for 3 sets more data and then acting too late. So the Fed is always reacting with a significant time lag no matter what. So they might as well cut now and then see, okay, how the data is evolving and make decisions accordingly, rather than say, okay, the first cut is so important, we have to get it right, and let's just be really, really super confident that inflation is heading back down to 2%. I mean, inflation is heading back down to 2%. Already, I think they don't need to be so hesitant in acting. And I think the market would actually appreciate a proactive Fed that protects the economy from further softening than a reactive Fed that is always chasing the latest data. If you enjoyed my video today, please hit the like button and subscribe to the channel. We're going to do regular updates on the Fed policy and the US macroeconomic data. So stay tuned. Thank you.